Welcome to Jill on Money, powered by the Compound. Today, it's a crossover event. It's exciting. It's like when the Jeffersons show up on All in the Family or vice versa. Some of you who are under the age of 40 have no idea what I've just spoken about, but that's that. I am delighted to have one of the very, very most influential members of the Compound and Friends family. That is Ben Carlson. His official title, he just told me this, is the Director of Institutional Asset Management. I don't know, Ben. What does that mean? How is that? What do you do all day long?
I talk to people like you on podcasts, I think.
Yeah.
No, I came from the nonprofit world and I worked with foundations and endowments, and we still have a handful of those clients that we work with. And so more working with organizations and family offices. And that's kind of my background.
And you're also a CFA. You have very fancy letters. And so you share that with your pal, Michael Batnick. So let's go back and do the Ben Carlson origin story. You are a Midwesterner. You are from Michigan. Is that correct?
Yes, West Michigan.
And that is Western Michigan, Grand Rapids. Mark, you'll be happy to know that Ben is in the listening area of WOOD radio. Ben, do
That's
you
right.
know what the motto is of Wood Radio or not?
I watch a lot of Wood TV. I don't listen to the radio much anymore.
Oh, okay. Well, you'll be happy to know that the first time I did a two-way hit with Wood Radio, the host said, "You're listening to Wood Radio, waking up with Wood in the morning." That's all I can tell you. So that was
All right.
that made us instant fans of that station.
I can't believe I didn't know that. Okay.
I know, it's great. It's a woodpecker gang. It has nothing else to do with it than a woodpecker. Very honest.
Keep your mind out of the gutter.
Yeah, exactly. So Ben, you grew up in Michigan?
Yes, born and raised here.
And how did you get involved in the investment world? Like, what led you to this place?
It was one of those things that just sort of happened. I kind of got lucky. I was one of these people. I look back on it now and I can't believe how naive I was in college. I didn't know anything. I did okay. I studied. I was kind of your 3.2 student. That's about. I was more interested in extracurriculars than I was in studying.
Mm-hmm.
And then I went to a very small school. I had dreams of playing football, and that didn't last very long because of the extracurriculars. I had more fun with a social life than anything, which I actually think helped me a lot in life. Being a social, because I'm an introverted person, and having a social life helped me a lot in college, I think, to get to know people and that side of things, networking, all that stuff. But they sent us away my senior year of college to Philadelphia and said, we have this internship program. Me and all my friends went because none of us knew what we wanted to do. And they said, we've worked with all these companies for years in any different industry you can imagine, right? Go interview with a bunch of these firms. You work with these firms and you get college credit. And I worked with a sell-side research analyst and a bunch of these CFAs, right? And they were tracking, this was 2004, and they were tracking internet security companies. So at this point, this is after the dot-com bubble had burst.
Mm-hmm.
And so I get to watch firsthand how these people talk to management teams and how they track stocks and how they set prices and all these things. And that was the first time I ever really learned about the stock market at all. Like
now,
the first day.
I'm going to just interrupt you for 1 second. So you used the term sell side. Can you explain to the audience the difference between the buy side and the sell side?
Yeah. So the buy side would be your portfolio managers, your hedge funds, the people who are doing research and then they're actually making investment decisions. The sell side is the research component of a lot of these financial firms. And they create research on these firms and then they put price targets and they sell this research to other people, and they don't actually make investment decisions. And that was a big learning experience for me. I think these people are putting buy and sell and hold and strong buy and strong sell, but they didn't have any skin in the game. And it's not to say that research isn't helpful to certain people and analysts and managers, but I realized oh, wait a minute. I learned about career risk very quickly.
And explain that. What is the career risk there?
Well, the interesting part to me was I still vividly remember this. We walked into a meeting and all the different analyst groups are there, right? The consumer discretionary people and the consumer staple people and technology and financials. And the guy who's the manager of the whole place brings everyone in, and there's 70 people in this room. And I'm on the outskirts because I'm the lowly intern, right? I don't know anything. And the guy says, all right, we have 115 buy ratings on the stocks that you guys follow. We have 70 hold ratings, and we have 3 sell ratings. And he goes, please, someone put a sell rating on a stock here. And they're all grumbling, and they say, listen, we can't put a sell rating on a stock because the management team won't talk to us if we do.
Oh.
And that the light bulb for me went like, "Oh, okay, there are incentives here." And that's the first time I ever understood like, "Oh, career risk. That's the decisions that you make sometimes in your career have nothing to do with right or wrong or good or bad analysis. It's incentives."
So what year was that when you were doing that internship?
Yeah, that was 2004. And again, I knew nothing. The first day I sit down and they asked me what I knew and they said, "Here, start reading the Wall Street Journal every day front to back."
But wait a minute, I'm saying what year of college? Sorry.
Oh, so I was a senior. So I was
Okay.
getting it. So this is like
Mm,
total kick in the butt for me. Like, Ben, you have to figure out what you're doing because I had no idea. Again, like I had friends who had their career planned out. Listen, I'm going into accounting. I'm going to be a CPA, or I'm going to do this, and I'm going to investment banking. I knew none of this. I was so naive. To in my defense, there weren't as many resources available as there are today.
mhm.
I went to a liberal arts school, so I couldn't really focus on any one area. And I get out, and it's funny, a lot of the jobs I was offered were like mortgage brokers because this is right as the housing bubble is heating up.
You're
And I
right.
think back to some of the jobs that I either turned down or didn't want coming out of school that I'm really glad I didn't because I could have got caught up in that whole thing and that would have been a mess. So I took a job on the east side of the state and it was a small consulting firm that managed money for hospital systems.
And that's so it's like kind of random because it's like you have this experience and then you're like, well, maybe I'll do this. And it seems like a great lesson here just for people who are watching about thinking like, here is this guy, Ben Carlson, very accomplished. By the way, when I Googled your name, there was a funny thing that came up, net worth, and the interwebs thinks that you're worth $30 million, and I hope you are. So anyway,
Okay.
that just I did just come up because I was like, what's his title again? And then I got pulled into something else. And so the funny thing
If
is
it's on
that
the internet, it has to be true.
absolutely, or on a podcast. You heard it here, folks, $30 million. But what's interesting to me is that, like, you were not the architect of a career. It's like the
Oh,
things
no,
that
not at all.
occurred, right? Like, things occurred, and I know so many people feel the pressure of having to create a career from, age 16 on. And there's a beautiful randomness to this. And so you mentioned two things that really stick out to me, which is, having a social life actually was valuable. And you went to a liberal arts college. So what's fascinating to me is that, you are a numbers guy. And I don't know if you knew you were a numbers guy early on, but
That's
those,
the only thing I knew that I
yeah.
wanted. I knew numbers and analysis, but that other than that, it was wide open for me.
But you could have then also, of course, been a scientist. You could have been like, "Hey, I'm a smart guy who's good at numbers." Or, I bet you were good at science also. You could have been a doctor. So, what do your parents do for a living? Like, what was the modeling?
Well, my dad was a CFO, so the numbers thing for me was,
There you go.
and my mom was a nurse, so that's the science side of things, I guess.
Yeah.
It's funny they both worked at the same hospital, so that's kind of how I got into like this hospital system of managing
Ah.
money for them. So, yeah, and I learned, hospitals are nonprofits, but I
Hmm.
learned very quickly that nonprofit does not mean you don't have any money. Because all these hospitals had a ton of money, and it was so they would have a pension and a foundation and an endowment and like an operating account, and then they'd have these malpractice insurance funds for the doctors who got sued.
Mm.
And that was my really big intro into understanding the importance of investment planning and asset allocation, because a lot of these hospitals would bring this money to us in one bucket and they would say, "All right, here it is. It's a 60-40 portfolio." And we look at it and say, "Wait. This fund or this bucket has a time horizon that's way different than this one." And so each of these needs its own sort of asset allocation and investment policy guidelines and all these things. And so I learned very quickly that it's not stock selection that matters as much as getting the big stuff right. Right? The asset allocation is what drives most of it. And that was drilled into me very early on and it was very helpful for me in my very first job that I ever came out of college learning.
And I love the idea that it's like the time horizon. I sit on a board of a nonprofit, and our cash account is held at like some Chase, and they keep saying to me like, we why did you invest this money? I'm like, this is our rainy day fund. We're a nonprofit. Now, rainy day can happen any moment. It has nothing to do with like a lot of bad things can happen in nonprofit land. Like we need this liquid. So like T bills are us. But it's fascinating because as the environment shifts, how so many people in these institutions are just about like, no, move into here. Don't go do this, go do
Yes.
this. And what a trap that is. It's also a trap for individuals because so I wanted to get to how you then bring this institutional experience. How are you introduced to Ritholtz? Where does this go from there?
Yeah, well, the interesting thing you mentioned, like the people who all have different ideas, I learned very quickly that there's a lot of politics in the nonprofit space. You're dealing with committees and donors and all these things, and I did also learn that there's so many more nonprofits out there than you could ever imagine. And I ended up working for, this consulting firm. Then I went to work for an actual nonprofit after I got married, and I'm working for a billionaire family managing their like $1 billion endowment fund. And it was great. But I realized quickly, like, I don't want to just help this billionaire family because I feel like the work I'm doing is interesting and fun, but I'm not moving the needle for them. They're going to be fine either way.
Right.
Right. And there's all these other little nonprofits out there that have 2, 5, 10, $20 million that are being overlooked, or they're being run by a bank and they're charging them egregious fees. And so I was at this job for a decade, and I just had to somehow get my feelings and thoughts out. Like, there's got to be a better way to do this. And so I decided I'm going to start a blog. And I've been following Barry and Josh for a while, and I liked the way that they had their own voice, and they kind of told it how it is, and they were transparent. And I asked my boss, would you care if I did something like this? And they're kind of like, what, a blog? They didn't, what? This is probably, I don't know, 10 years ago, 12
Mhm.
years ago. And they're like, I don't care. Go for it. You're not sharing company secrets.
Right.
What do we care?
Right.
And so I did it and started writing and realized that I liked it. And the funny thing is that I was writing specifically for my friends and family that were constantly asking me questions as the CFA investment guy, right? What's
Mhm.
the stock market going to do? Is it going to go up or down? What's the election mean? What's the interest rates mean? All this stuff. And I got sick of answering their questions. So I said, I'm just going to write about it in the blog. So I tried to write in very plain English. And they were the only ones who signed up for my newsletter for the first 6 months or whatever. But then I realized slowly but surely I had these people trickling in, and I would get emails from advisors saying, hey, I love the way that you explain this stuff in a very simple, digestible manner. Can I share this with my clients? And I was not working in the wealth management space, right? I'm still in
Mhm.
nonprofits. And I'm kind of thinking like, oh, interesting. That wasn't my intent, but
Right.
that's the way it happened because of the way that I was trying to simplify stuff. And so I grew this bigger audience, and eventually had the nerve to email Josh. And I emailed Josh and told him about some things that I found wrong with the institutional space. And I was a really big, uh, I was totally against the hedge fund stuff coming out of the crisis. Like, everyone was investing from the fetal position after 2009, and the crisis was over, and everyone wanted to put money in hedge funds
Right.
and black swan funds. And I see the stock market down 50%. And I'm thinking, this makes no sense to me. Why would you not? This is the time to blood in the streets, right? I've been reading all these Warren Buffett books my whole life. If not now, when? And so I was kind of fed up with the way that, again, career risk kind of found its way into these different funds, these nonprofits. And I told Josh about it, and he said, well, if you really hate this stuff that much and it really bugs you, why don't you like write up a blog post for me? I'll post it anonymously so you don't get fired from your job. And I said, okay. And I worked really hard on it. I sent it to Josh, and he published it, and it was great. And that's kind of how my intro to Josh was. And I said, oh, by the way, I write this blog too. And Josh was very good about putting other people on the map. He was sharing links all the time. He was very good about helping other people out, because I think he had some help too from people like Barry when he
Mhm.
started writing. So
Right.
Josh started sharing my stuff in his links, and he would tweet out some of my stuff, and he started following my blog, and that slowly but surely helped me build an audience, because Josh already had an audience.
Mhm.
So it was kind of the kindness of strangers. Josh didn't know me at all. And then I am traveling to New York 2 or 3 times a year because I'm meeting with private equity managers or conferences and such, for my day job. And I reached out to them a few times, and Josh and Barry and Michael, and said, hey, guys, I'd love to meet up, because we had this little financial blogging community.
Mhm.
Right. And so I
Yep.
got to know them a little bit. So I got to know them for a year or two, and it was great because I've been reading these guys forever. These are like my financial blogging heroes,
Right.
and getting to know
These
them.
are a little bit of your idols, right?
Oh yeah, definitely.
Okay.
I'd read everything that they'd written. I follow them. I'm watching Josh on CNBC and Barry on Bloomberg and all these things. And I don't know. After getting to know them for a while, I'm having a conversation with Josh about something in my career and just complaining. Hey, I don't. This is not what I want to do. I want to work with. Now that I've got a taste of this and I'm getting emails from people and feedback from my blog, I want to work with more than just one client, this one billionaire fund. I want to work with different people in smaller organizations and nonprofits. And I just want to do something else. And I want my writing to actually lead to, people coming to me and asking for help, kind of like you
Mhm.
guys are doing. And Josh said,
Yeah.
well, why don't you come do that for us? I said, oh, really? And that's not what I was expecting, because, they're in New York and I'm in Grand Rapids, Michigan. And this is pre-pandemic days of working remotely,
Yeah.
right?
Yeah.
And Barry and Josh said, okay, why don't you move to Manhattan? And
Whoa.
yeah, I think my daughter was 1 at that point, and so that conversation with my wife, as you can imagine, never got off the ground. And And I had a conversation with Michael saying, well, why do I need to move to New York? How many clients do you even have in New York? You get all your clients from the internet.
Right.
And they kind of said, oh, you know what? You're right. You don't need to move to New York. You come here every once in a while. You work remotely. The first day I joined, we put Slack and we got everything. And now we have, I don't know, 70% of the firm works remotely.
Amazing. Amazing. So, but what were you doing for them? Like this was, as I understood it, when they first started Ritholtz, which was, I don't know what it was, 10, 12 years ago, they are an investment advisor, financial planning firm. You're institutional guy. So what is it that you're bringing for them that they need?
So they said, listen, they had one nonprofit client and they said, we don't know what to do with them. That we got them because we had their 401k and they also had an endowment fund. And the whole thing was kind of a mess and it was spread between like 3 different financial advisors. And they said, we've heard from other nonprofits in the past. We don't know what to do with them. We don't understand this space. We don't understand working with committees and building the plans for them. We don't know the difference between the pensions and endowments. And they said, you do that for us. And you can also bring in individual clients through your blog and you can work with our family office clients and bigger clients. And we were very small at that point. I was the 6th or 7th employee, I think, and we were managing $100 million or something. So we didn't have a ton of big clients at that point. And it was just kind of like, listen, we're planning on getting bigger. We want to bring you in to help us grow. I was like, all right, that you can still write your content. You can do all this stuff. And I said, that's perfect. That's what I want to do. And so that was the idea. And I came in and I worked with our very first nonprofit client. Again, and it was funny. This client had never looked at all of their different money in one spot before because they had 3 different advisors managing it.
Yeah.
And it was kind of like, what do you think your asset allocation is? And they said, I don't know, probably 80-20, 70-30. We really don't have to use this money for anything. So we want it to be long-term. And I looked at it and I said, oh, it's 30% stocks, 70% bonds. And they said, oh my gosh, no one's ever told us this before. And so there was a lot of those type of situations where it was this nonprofit who, listen, this thing's a mess. We've had our brother-in-law running it. Can you help us kind of thing? And so we got a lot of those little nonprofits in that we help now and we have kind of ready the ship for them. And yeah, and I still produce content and it's our whole ethos is the content is the marketing and the sales and communication with clients and all that stuff. And that's
But
what we
then
do.
how about like you do dip your toe in the water of personal finance because you host the show that's called Ask the Compound. So how did that come about?
I've always just been interested in, and that's one of the reasons that I started my blog, I think, in the first place. Not just like I was, I needed to do something else with my career and I needed to get out of a rut. But my blog is called A Wealth of Common Sense. And my brother and I would always hear these stories from friends about making these huge money mistakes. And I would always say, like, just use some common sense. Like, it's simple, right?
Yeah.
But then you think about it more, and it's not just common sense; it's also the psychology behind it. And so that stuff just interested me more. The personal finance side of things is how can people be so bad with their money, and how can we help them make better decisions? And so so I'd worked on the professional side of things, but the individual personal side of things always interested me more because I was trying to learn that for myself too. Right. Because I've met with a lot of people in the finance world who are great when it comes to running numbers and managing money for clients and are terrible at managing money for themselves.
And then this process of like diving into some of the more personal finance, did it make you want to be an advisor yourself or you're happy? You know what I mean? Like I feel like there's always 2 types of people. It's like the people who really love like diving into the numbers, but then there's also the part of helping people. And, sometimes I think a lot of folks who are considering this industry get spooked. I was just talking to someone in the industry who said to me, like, why do you think that so many women particularly are not choosing the world of financial planning? And I said, well, I think there's like this inherent fear that I just always have to be selling. And that, if you're kind of like a quiet introvert, it's hard to get beyond that. So what do you think is the benefit for you to either be on Ask the Compound, and why not be a full-on certified financial planner working with individuals?
Well, someone told me once that blogging is sales for introverts, and I'm not a salesperson at all. That was never my thing. The joke I always make is that like the the guy who could sell a ketchup popsicle to a woman in white gloves, right?
Yeah.
That's Barry and Josh. Like those guys are born with that gene. I
Mm-hmm.
think it must be a New Yorker thing. That's part of it.
Not only, but okay,
No, a
possibly
little bit.
part of
But
it.
that is not me. I'm not a born salesperson. And so the thing that I liked most about the blogging and the podcasting and communicating is like, for me, it's not selling if it's something I believe in, right? If
Right.
it's being transparent, that's not sales to me. Like if I'm selling a product that I don't believe in, or like the whole used car thing, that whole,
Mm-hmm.
stereotype, that I could never do that. I could never sell something. But the fact that I got to work with a firm that I believed in, and the thing we're selling is something that I actually like wholeheartedly believe in. Like when I first joined, I brought my parents in as clients. Like my dad had
Mm-hmm.
another financial advisor. And I said, Mom and Dad, you're coming in, we're managing your money now, right?
So
This
that's where the 30 million comes from, obviously. The
Yeah, right.
aforementioned 30 million. I see now. Okay, I get it. But okay, but like in some respects, having one foot in both worlds serves both sides, I think. Because I do think that sometimes when people are institutional managers, they forget who the end person is.
Yes,
Who is the
I totally agree with
pensioner,
that.
right?
Yes.
It's like these are people, right?
Yeah, the beneficiaries, that's who you're managing the money for, not the trustees and not the yeah.
Yeah, exactly. So let me ask you, just before we get into what I really booked you for this appearance, and now you're like, oh God, I've stuck with this poor woman for okay. But as you look ahead, do you sense that the industry is changing in some respects because you have like these just a high concentration of people who just want to go to a wirehouse, right? I want to go to Morgan Stanley. I want to go to Merrill Lynch. But then there's this, I think, like a sense like I'd like to be with these independent folks, whether it is a Ritholtz or it's my friend Michael Goodman at Wealthstream Advisors, like these large independent firms. They have a back office, but they don't answer to an organization that may not have my best interest. So do you sense that there's a shift there?
Yes, especially when I hear from young people. I think young people are so much more educated in understanding of you mentioned the career path. My career path was just I'm blowing in the wind and I
Mm,
landed somewhere and I got lucky. So many more young people know exactly what they want to do now. And they come to us and say at a very young age, like right out of college, listen, I tried this other approach working for a big financial firm and I can't stand the incentives, or I can't stand having to push products down people's throats that I don't believe in. And so many young people get that. Like that light bulb for me did not go off right away. Like I didn't understand that right away. It took some time and learning of this is what I don't want to do and that's what I don't want to do and now here's what I actually want to do.
yeah.
Young people these days come in knowing I want to do this, and the hard part for them is that finding that like dream job on day one when you know it is very difficult to do, especially if you don't have a lot of experience. But yes, I think there's a huge sea change of young people that say, I want to go the independent route because I want to be transparent. I don't want to be beholden to some big company that's going to tell me what to do and make me put them in products or portfolios or services that I can't live with, or the client doesn't need. And so yes, I think the young people today are way more informed on that stuff than people were in the past.
And I also, so I want to make the shift now. So now we're going to talk about your expertise, which is your investment management. And we also wanted to bring you in to help us with a real problem that a lot of our viewers and listeners have been sending to us. It just is questions. And it kind of boils down to I really do not know how to sell. And this makes people crazy, right? Because they're like, well, I'm coming towards the end of the year. I know I should be doing this thing called tax loss harvesting. I know I should be making moves. How do I force myself to do that? So, what is it that we can do to help people understand uh, not to have too much in in one asset, but also to be okay with selling, with leaving maybe if it goes if your S&P 500 fund was supposed to be 60% of your portfolio and now it's 82%, but you can't bear to sell because you don't want to pay the taxes. What's the answer to that person?
It is funny. I always say that in bear markets, it always feels like it's too late to sell but too early to buy. Right? There's never that sweet spot, and I feel like the bull market is the opposite. Like you feel, oh, I'm going to sell early. I just know it, and I feel like these are the kind of things that you need to have some sort of like guideposts around. Right?
Mhm.
Every time I go bowling with my kids, they have the bumpers that come up. I
Yeah.
feel like you need bumpers when you're making these decisions, and that could be some sort of rebalancing rule, right? Because the question we've been getting asked to Compound more than anyone is, listen, I bought NVIDIA 3 years ago. It's way bigger than I ever thought it could be. I know I need to sell and I should diversify, but I don't want to sell out of something that's going to keep going up. So I think having some rules ahead of time to guide your actions, I think that's the biggest thing for most investors is making good decisions beforehand so the emotions don't get in the way. So listen, every time a single position is 5% of my portfolio, I'm going to trim it back, right?
Yep.
And if it gets back down, goes from 5 to 2, then I'm going to buy a little more or whatever it is. I think you have to have those decisions made ahead of time. Otherwise, you're just guessing.
And are you a believer that like the stock picking part of anyone's life, like their fund money account, what percentage of the invested assets do you think that is going to keep people out of trouble?
Yeah, I guess it really depends on the individual, but I'm fine with people scratching that itch if they have to. But if it's, I don't know, 10, 15% of the portfolio, 5 maybe for some other people, that's probably plenty as long as you leave the other 90, 85, 95% alone.
Hmm.
I think that makes sense for me.
Okay, so let's talk about the alone part. So, the stuff that's like my passive investing, my index fund investing. You are a believer in the passive investing structure, right, Ben?
Big time.
Okay,
I'm a boglehead.
I love that about you. So, how can people who are adhering to that who struggle with this idea like, well, okay, Jill, thanks. Tax loss harvesting. It's 2024. Everything I have has made money. What should I do? Should I still have that same discipline? Why should I take the gain today when I could do it next year? What do you say to those folks?
That's a good question. I mean, I guess that gets back to the rebalancing line of thinking as well, and understanding like what is your asset allocation in the first place. That's the hardest question for most people. Is like if you have an allocation, the whole point of it of setting an asset allocation is because you have specific risk profile and time horizon, and you want to match that. So an asset allocation doesn't necessarily mean you're going to get like the highest return. It means you're trying to get like the highest return for a given unit of risk,
And
right?
for you, like
Yes.
right,
Right. So
your risk tolerance.
if your asset allocation is 80% stocks and 10% bonds and 10% stocks or whatever it is, and now your stocks are at 85%, the whole point of that diversification and asset allocation and risk management is that you set that ahead of time. So I think those are the kind of guidelines you have to use when making those decisions. So you actually have a framework. And for people who are just guessing, maybe it's time to create a framework, right? If you don't have one.
Right. And I think the part that is really interesting, and by the way, Ben's blog, I love it. I've been stealing charts from it just when I do presentations. I put your name on there. Don't worry. It's good. You do a lot of work around, hey, you don't have to be a hero. You don't have to find the bottom of the market. You don't have to sell at the top. Here's what a portfolio of stocks has done over the course of the last 50 years. And then you slice it up into time horizon. And I thought what the most interesting one was you recently did a balanced portfolio chart. And I'd love for you to talk a little bit about that because, Ben, to be clear, although I was a derivatives trader in my youth and it was a lot of fun, I am a wimp. I am a self proclaimed wimp. I would rather work a little bit harder, scrounge up another speaking engagement, do something else to earn income than be a 80-20 investor, even though it would have worked out better given my age. So, talk a little bit about what a balanced portfolio and the performance it has delivered versus being that 100% in stocks, which sometimes has so much risk that you don't even realize it on the way down. That's when you're like, oh, wait, it's too much risk for me.
I like that you admitted that because I think that's the hard thing for most investors is understanding themselves and
Hmm.
not like confusing their own risk profile with someone else's. Like, it's okay. I think everyone has their own personality and their own like lesser self. And I think you have to know what your lesser self is. Like, what are you going to regret more? It sounds like you would regret taking more risk more, whereas other
Hmm.
people, would regret not taking enough. And I think that's a big part of it. Um, so are you talking about my win rate one for the 60/40 portfolio
Yeah.
or a
Yeah.
different one? Okay. So I looked at the win rate of a 60/40 US portfolio because I've done this a lot for the stock market, right? The longer you hold, the better your probability for seeing a gain historically, right? And the
Right.
fact that like the stock market has never seen a down 20-year period on a total return basis going back to the 1920s for the US market, right? Taking away taxes and fees and all this stuff, right? The usual caveats apply. But for a 60/40 portfolio, it was like there's never been a down 7-year period, right? Or a down
Amazing.
10-year period. And like 100% of the time, you have this diversified portfolio. And I'm looking at it where, again, back to the asset allocation thing, my rule was you rebalance at least once a year, right? You rebalance back to that 60/40 because if the stock market is going gangbusters, you're going to have more in stocks. Then you bring it back into line because of the risk management. And the win rate for the 60-40 portfolio is pretty darn good, right? No 10-year periods going back 100 years where you've had a loss with that portfolio.
It's amazing. So this is why, gang, even though I'm a complete wimp and I've left money on the table, I feel comfortable. I feel good. Ben, what's your lesser self? What's your Achilles heel?
Oh, that's a good question. I think everyone gets a little bit of FOMO, and I definitely got that, especially in like the 2021 period where we had the meme stock stuff going on,
Mhm.
and that's why I still, even though I'm a boglehead at heart, I still allow myself to have that fun portfolio
Mhm.
just to have it. So I have some crypto in there, and I do some stock picks, right? And I have maybe some ETFs that I wouldn't have in my other sort of core portfolio. And it's not a huge piece of my portfolio. I think it's, I don't know, 7% or something like that. I have a Robinhood account, and so just to get over that FOMO, I remember I bought Bitcoin for the first time like 2017,
Mhm.
and it was one of those things where I was beating my head against the wall because I did not understand it. I didn't
Mhm.
understand it at all. I still don't really understand. I kind of get it. I guess millennial gold is the way that I'll explain it. But
I like that. I like that as a definition.
I bought it just because I said to myself, if this thing keeps going up and I still don't get it and I'm beating my head against the wall, it's going to make me way more angry to not be a part of it, right? And I didn't put a huge amount of money in. It's just enough to like make me feel satiated that okay, I'm at least taking part in this whole thing. And I've ridden the roller coaster up and down, and I kind of said, I'm going to put some money in it, and I'm just
Yep.
going to let it ride. I'm not going to. That's my rule ahead of time, right? I'm going to let this ride. Whatever happens with it, it is what it is. And so I have that part of my portfolio where even I need that piece to scratch the itch, just to leave the other stuff alone.
Don't you have some hobbies? Like what this is the thing you gotta that's the itch you gotta scratch?
Well, for investing, no, I listen. I have 3 children. I don't have enough time to have hobbies.
How old are
You
your
know,
kids?
my oldest is 10, and we have twin 7-year-olds. But
Oh my
my
god.
form of meditation. I've never been a meditator. I go for a run 5 times a week, and that's
5
when I
times a week, you are young. God bless you.
yes, I'm trying to stay young, I guess. But
I like that.
that's when I do my most thinking. Like I get back from a run and I jot down notes for my blog or for the podcast or something else. Like that's when I do my best thinking is like I get out of the office once a day for a half hour and I go for a run and I come back and then that's like my the light bulbs go off because
Yeah.
I everything else is oh wait, there's no screens, there's no nothing. It's just me and the road.
So if you're looking at like a year-end kinda to-do list for an individual who's watching this, and it's not just portfolio, I know that, but we're gonna kind of stay in your lane. Like, what are the things that, we talked about make sure your allocation is in line. What else should people be doing as they approach the year end and in terms of looking at their investments right now?
Well, I do this once a year for my own personal money. I At the end of the year, I update my all my balances for my retirement accounts, my IRAs, my brokerage accounts, and then I also look at how much money I saved for the year, right?
Yeah.
And I think it's important for a lot of people to make sure that you're saving a little bit more money each year. Now that could be I'm going to save $50 more a month this year, or I'm going to take my savings rate from 12% to 13%. Like I like people to slowly but surely bump them up. I think making a big leap, unless you get a huge bonus or you get a big raise at work, I think doing it slowly but surely is the way to kind of stick with it. Like my favorite thing to do is if you get a 3% raise, save half of it, right? Save 1.5% or whatever. Like, so you're giving yourself more discretionary spending, but you're also increasing your savings rate. So I like the idea of like slowly but surely working your way up to a target goal as opposed to just doing it all in one fell swoop.
I love the idea of like quantifying your savings because it makes you feel better. Because sometimes I'll talk to people and they'll be like, I live paycheck to paycheck. I'm like, but you're both maxing out your retirement accounts. You're putting money into your kids' 529, and you have actually added a little bit of money into your brokerage account. Oh, I know. But after that, I feel like I'm living paycheck to paycheck.
Yeah.
So I think it's a
You
good
should. You
thing,
should be
right?
living paycheck to paycheck after that, right?
Right? That's
Essentially.
amazing, right? Okay, so I love that. So asset allocation, savings rate, and what else? What else should we be looking at? Should we sell some losers if there are some? I mean, there have to be some losers out there.
Yes. Well, we looked at this before. Like on average, 30% of all stocks in the S&P 500 in an up year or a down year are down in a given year, right?
Hmm.
That's on average. And even in good years, there could be 20 to 30% of stocks that are down. So if you hold individual holdings, yes, there is a chance that you could have some that are down. now is not a bad time to lock in because you're going to have some gains to offset as well. Even if you're not selling anything else, it's just dividends and income and those sorts of things. Um, on the personal finance side of things, though, I also like creating new savings goal buckets. I don't like just having a big bucket of this is my emergency savings account, right? Because that if
Mm-hmm.
you don't have any definitions on it, I like to give every piece of my budget or my savings a job, right?
Mm-hmm.
So I like to bucket it out by within that emergency savings account. These are for car repairs. This is for trips. This is for a wedding I'm going to in Colorado, whatever it is. I like to have those different kind of goals in there. So I think defining those goals can be helpful as well, starting a new year.
So, last bit before we go. So, what is the biggest mistake that you think people are making when it comes to their investments? We've talked about not getting the asset allocation right, but let's talk a little bit about the emotional pull that we often have. How do you see that people can overcome some of those cognitive biases besides the rules? Like, I always say, you know what? I don't trust you and you shouldn't trust you. That's why you should work with an advisor because for a lot of these people,
Yeah.
they're going to have rules that they break all the time. So,
Yes.
how do you know when it's time to say, I don't trust myself?
Yes. And I think when I first started my blog 10 years ago, I would have said, just ignore the noise, right? But it's not, you can't ignore the fire hose, right? It's ever present. So I think the great thing about technology these days is that it allows you to take the bad pieces out and just automate good decisions ahead of time, right? So you automate your contribution rates to your retirement accounts and your IRA. And so when your paycheck comes in, that money automatically goes out, right? It goes out to your brokerage account. And I say to treat your savings like it's a Netflix bill, right? It's a bill that goes out every month, right? It's not like I'm just going to save whatever's left over because usually you spend whatever's there.
Right.
So you save ahead of time, you spend whatever's left over, and then you automate your rebalancing, right? So you don't have to think about it, like your tax loss harvesting, right? You automate those decisions, and because most fund providers or financial firms have the ability to automate contributions, automate dividend reinvestment, automate rebalancing. So I think as much of that automation as you can do, where you completely take yourself out of the equation, like, I think that's the best thing is it's just pulling yourself away from it.
And okay, my real last question is you and Michael Batnick are best buds, right?
Yes.
Do you get jealous when you hear him with Josh? Do you have a little bit of like, "Oh, it sounds like he's having more fun with him than with me." Do you feel that? I mean, I know that must be hard for you.
No, absence makes the heart grow fonder. So the funny thing is that, because back to the New York thing, New Yorkers really like to yell a lot, right? And I'm the quiet Midwestern person. And I think the fact that I'm not in that all the time, and I think that makes it, whenever we get together, we make sure we have a great time together. So I don't mind. I say absence makes the heart grow fonder.
I can't wait to come to Grand Rapids. I'm gonna come visit you. I'm gonna come wearing my WCCO, I Woke Up with Wood T-shirt, which I own, and I am delighted that you joined us. Ben Carlson, we will have links to his blog and his wonderful shows that he produces through the compound. Ben, you're the best. Thank you so much.
Thanks, Jill.
And thanks for watching. If you've got a comment, just give it to us. We can take it. It's all right. I know you're going to love Ben, so that's the best. So don't forget that you can subscribe to us. What do we do, Mark? We subscribe? Do we join? What do we do here? I forgot what channel we're on now.
Subscribe, you follow, you like.
All right. You subscribe, you follow, you like. Oh, if anyone's sending me notes on social media, Mark is answering them. I don't go on social media. That is it. My skin is way too thin. So don't expect me to. That's Mark, not me. Blame him if you don't like the response or the response time. All right. Thanks so much for watching.